Good afternoon, everyone, and welcome. My name is Karen Roche. I'm a partner with Calibre CPA Group. I want to thank everybody for joining our not-for-profit webinar, The New Donation, Cryptocurrency. My role at Calibre is I specialize in accounting, budgeting, financial reporting for tax-exempt organizations. I'm honored to have Dennis Chyba with us today. Dennis is the founder and president of Adcieo, a consulting company whose mission is to help nonprofits where development and technology intersect. And so Dennis has an expertise in web development, strategic campaign planning, and fundraising, and he has successfully assisted many nonprofits in incorporating acceptance of cryptocurrency into their fundraising platform. So today, Dennis and I together will discuss some of the fears that may be preventing you from accepting cryptocurrency donations, and we'll also help you to understand what your organization should know about crypto and how to traverse this method of digital donations as it continues to gain mainstream attention. This is our second webinar in our not-for-profit educational series that we plan to host throughout 2022, so stay tuned for more coming up in the summer in July and then again in the fall in October. And if you have a topic of interest, please feel free to drop it in the Q&A section or in the chat, and so we can consider covering that for one of our future events. And before we jump into the content, which we're going to jump into because there's a lot of content there, let me take just a minute to let you know how the webinar is going to flow today. We'll have hopefully we'll have time for at least a brief question and answer after the conference, but if not, we will respond to answers that you send us at a later date. Some of the questions might entail more complex answers, and so if we don't have time to address or we don't have the information at hand, we will let you know, and we encourage you to reach out after the webinar to us directly, and we'll be happy to address any questions you might have. If you're interested in obtaining CPE for today's session, you'll be prompted to answer polling questions throughout the conference, so please make sure to answer those as they pop up. And also for the CPE after the program, you'll receive an email with instructions on accessing the program materials and requesting your 1 hour of CPE credit. So let's jump in to our presentation. The new donation, cryptocurrency. We have found in preparing this webinar and researching that it seems like people are coming down on two sides of cryptocurrency, either Team FUD, fear, uncertainty, and doubt, or Team FOMO, fear of missing out. So we thought it would be kind of fun to work this webinar with presenting both sides. So I am a charter member of Team FUD, and I think many accountants are also of that mindset. And Dennis is a charter member of Team FOMO. So we're going to look at both sides of this issue. And we want to start out our next slide with just some general facts about cryptocurrency that I think will help us set the stage for our discussion. So if you can advance one slide, please. There we go. Just some general facts. CoinMarketCap estimates that right now, $1.8 trillion is the total market capitalization for all cryptocurrency. That's a lot of money out there, or a lot of value out there, not money, in digital assets. 19,100 different types of cryptocurrencies. Bitcoin and Ethereum, which are the ones that most of us are most familiar with, represent in total about 60% of that total market cap. And then NFTs market cap is currently exceeding $10 million. Dennis will tell us a little bit later in the presentation about some of these other digital assets which are not cryptocurrency but nevertheless gaining mainstream attention. Pew Research in 2021 estimates that 16% of Americans have invested in, traded in, or used crypto at some point, and that number is growing. Fidelity Charity reports that reported 13 million worth of crypto donations in 2019, 28 million in 2020, and 158 million in 2021. So what we're trying to show you here is that cryptocurrency is here and it's not going away. It is gaining mainstream attention as we speak, and it is something that we need to be prepared for, because it's going to come our way. There are donors out there who want to donate, and we need to make the decisions as to whether or not we want to accept those donations. So what are we afraid of? It's the typical fears that approach us all the time. We're a fear of the unknown, fear of change, fear of the volatility. It's a fact that the crypto is very, very volatile, more volatile than our traditional securities. And we're also, that fear that we have is fueled by the lack of structured guidance by regulatory bodies. Us accountants really rely on that structured guidance that we get from the FASB, from the AICPA, from the IRS, from the DOL, et cetera, et cetera. We like those rules and regulations because we know how to comply and report against our typical rules and regulations. And in this arena, we don't have clear structured guidance, and so that definitely causes some fear for us. So fear of change. It is very difficult for people in general, and I think it's especially true for accountants, to step outside their comfort zone. And when we talk about accepting cryptocurrency donations, we're talking about stepping way outside that comfort zone. And it means changing our gift acceptance policy, indeed changing the whole donor profile in many instances, as well as addressing valuation considerations and accounting policies and procedures. It involves more than just the accounting department. It involves senior management and the board. It involves our development, marketing, communications, IT. So it's going to really stretch all of us as an organization to make changes if we want to incorporate cryptocurrency and digital assets into our overall donor platform.
So now we're talking a lot about fear, and I go back to 1933 and FDR and being told that the only thing we have to fear is fear itself. So really, when we think about this and we think in terms of crypto and what is the chasm that we have to cross from where we are with any fear that we may have to accepting crypto in a nonprofit organization. Let's think back. There was a time when electricity was feared, that the idea of wires in a wall were seen to be more dangerous than oil lamps hanging on the wall with wallpaper and everything else. But today we've conquered the fear and we love our lights. In 2000 or leading up to 2000, there was a ton of fear about the change in a 2-digit to a 4-digit year column and what that was going to do and how many systems were going to crash and what was life going to be like on January 1, 2000. But we surmised and moved on, and we're 22 years in at this point. Similarly, online registration systems. I can remember when I was with the YMCA during this time, actually, Y2K changes, and also during a process of moving our offline registration process to online. What we found was that the greatest impediments, the fear that we had, was really because we just did not have the defined policies, as Karen just mentioned, right? That we look for guidance, we look for things, but when at the Y you would have offline registration, it was always up to the staff person to be trained to know how to deal and process with that registration. But if we were going to allow people to register online and do so from their home, that would mean that we'd have to have all of those policies and processes well-defined in advance and also built into the online process so that it was automated. That just required extra effort, thinking, planning, and we couldn't rely upon the technology to just make the common sense answer and process. Whereas if we had a staff person meeting with a member to handle a registration, they would be able to make those changes live in real time. So it's just a little different. Similarly, we've implemented processes where, from a fundraising standpoint, we've integrated wealth profiling, identifying of those that have the greatest ability to make a gift. We identify people that work for a matching gift company, and we flag that. We utilize the technology that's out there, the data that's out there, in order to help us do our missions and fundraising for those missions a little bit better. We've implemented automation, and today we're seeing 18-wheeler trucks drive cross-country with no one in the driver's seat. So we're seeing technology and change that's happening real time in real ways. So all of these we've had to address and become more comfortable with. So I think that crypto is very much like that. And if we can define it, we can put the processes in place, we can then implement the solution in a way that makes sense for the organization. And if we look at the next slide, motivation, everything we do when we think about fundraising is really about delivering the giving experience so that the organization can have the funding to deliver on the mission. And years ago, we used to get a lot of data, and we'd get data in different capacities. But where we are today is we really do expect knowledge. In the way in which we operate, the way in which we use tools, we really need that knowledge, because that's what allows us to take advantage of the data and do something a little bit better. But we think in terms of how organizations are able to actually then provide the experience for the donor and reward them with a giving experience, and that's that emotional connection that they are able to feel that they've made an impact. And what is the level of incentive, and how do we use incentives? And those incentives could be running from actual items. There are certain types of organizations that their fundraising model is very much based upon incentives, and based on the level of gift, you're able to achieve something. But what we do know is that regardless of incentive, donors do want to give. They want to be a part of it. And this is something that we've seen through each of the different generations. Even though each generation, they engage and they basically want to give to different things, and their motivation for giving is slightly different. But one thing that we have seen, and this goes back to United Way days, when, if you think, what did United Way do? United Way initially created an opportunity for the common person to make small gifts to a charity. And prior to United Way, a lot of giving was probably more faith-based, where individuals were actually going into a church or participating actively. But United Way brought together the idea of a nonprofit community at large, allowed someone that is working at a normal, regular job to give $1 a week, $5 a week, whatever it was, out of their payroll before they even received it, and then choose either an organization to receive it or choose a programmatic area that they were inclined to support. That initial process, there was a lot of benefit in the whole idea of United Way and giving pre-tax dollars, and how beneficial that was. Crypto, we see that as well today. And we have seen it in terms of stock transactions and donations the last few years. But there are a lot of individuals, even though crypto is volatile and it's down today compared to a few months ago, it's up compared to a few years ago. So there are individuals that have a large gain, and they do see the benefit of the tax treatment that can be there for that. And then, the final thing around that is, how do we look at the opportunity and the ability for individuals to actually make an impact? That's kind of the key aspect there.
So those opportunities for making impact, the fact that our donors want to give, Those are strong motivations for all of us to think about this, to think about change. But we also have to deal with our fear of the unknown. And that's where knowledge, we can start to educate ourselves, because most of us don't really understand what, if we're not dealing in it, we don't really understand what cryptocurrency is. We don't really understand the different digital assets and how some might be safer than others. We don't understand what blockchain is really and how blockchain relates to digital currency. And if we make the leap and we decide, okay, we've got donors who want to give and we want to take that money, we don't really know how to do it. It's not something we've ever done before. We don't know how to do it. But the one thing most of us do know is we don't want to personally dive into the dark web. So what we want to look at is first of all, educating ourselves, because part of what we do as accountants is we identify and define the risks, and then we see if we can put controls in place to mitigate those risks. We want to operate in an environment that has strong internal controls, and we want to be able to identify all of our risks. So that's part of what we want to help do today, is just give some of that education so that we can learn a little bit more about what cryptocurrency is, and address some of these fears and break them down, and then at least hopefully put ourselves in a position where we can make an educated decision and possibly start dipping our toes in a way that we feel comfortable with strong internal controls in place.
So, and let's break apart crypto versus blockchain. And so we're going to talk about blockchain on the next slide. Right now, let's talk about crypto and what it is. So on the left, you'll see Bitcoin standing in for all of the different types of cryptocurrencies that are out there. On the right, you'll see the dollar and a few other currencies that are classified as a fiat type of currency. And so let's think about it in those terms. So I think a couple of the key images here on the screen right now. On the left, you'll see a purple and a pink computer, signifying that crypto, or Bitcoin in this case, is a transaction between two individuals. There's no intermediary. Versus on the right side, if you see the orange and the green computer, and you'll see what appears to be a bank in between, the idea of a fiat currency is that there is some sort of third-party regulatory type of agency process in place that takes place. So a bank, for example. That's number one. The other thing that I think is really important to think about is that on the left side, you'll see the yellow and black dots. And basically what this means is that on the crypto side, it's governed by majority rule. And so we'll talk a little bit about what this means, but it really comes into the blockchain and the way in which authentication really does happen. Whereas on the right side, it's governed by a central bank. So at this point, there's not a day that goes by that we don't hear about the Fed and interest rates and inflation and policy that's going to change how people can interact and potentially the value of the dollar or any other currency. So these are policy decisions, they're made, they're changing real time. And at the end of the day, when we think about this and people say, well, crypto is not backed by anything. And I would say, okay, fiat money, what is fiat money really backed by? US dollar is backed by the full faith and credit of the US government. Now, if you think about this, the US government, and we don't need to pull up the debt clock, we all know this, we have a lot of debt as far as the US government is concerned. Japan has a lot of debt. And these currencies are backed by those governments. But that's it. It's just the goodwill of the government to say that these currencies are worth what they are worth. Whereas on the Bitcoin side or the crypto side, it's backed by that community. And now on the next slide, we'll talk a little bit about blockchain. So blockchain is the technology that allows us to use crypto. Think of it in that terms. It's truly the technology. And at the end of the day, the real key thing is, in this summary right here, I think is really easy to understand, but it's basically clusters of information or blocks of information that's dispersed out. And this is where, in many ways, blockchain is very secure in that it's, in order for any transaction to take place, it needs to be validated, depending upon the blockchain, by many different decentralized data sets. So it's not all in one place. When a transaction takes place, it has to go out and hit many different servers and come back. And this is why oftentimes we hear Bitcoin is not environmentally friendly, because of the way in which it is developed. It is energy intensive. There are other blockchains that are less energy intensive, but that energy intensiveness is because it's going out to hit many different servers to validate before a transaction can take place. So really, if you think about the blockchain, is that it truly is a ledger. And not only is it a ledger, but it's a ledger that one person cannot control. So that adds security. And that the second piece is that because it is anonymous, even though you can see all of the transactions, the anonymity of it actually adds a level of security to it. So really looking at the technology at the core, and then understanding the kind of the currency that sits on top or might be operated on top of the actual technology. I think that's really important. Now, when we think in terms of this particular slide deck, what we can say is that right now, this is mainstream. IBM has been using blockchain for its health pass. IBM was one of the earlier adopters to blockchain technology, and it's out there, and it's in healthcare arena. And if we think about, at the end of the day, financial data and health-oriented data are probably the two most regulated and what we assume to be, should be protected data sets that are out there. But we see companies like IBM with healthcare. We see JP Morgan Chase, and basically their use of blockchain is interbank transfers to speed up that process. Microsoft has implemented blockchain technology to pay royalties to its developers that develop on its platform. NBA also has developed blockchain, and NBA is kind of interesting because we'll talk more about what NFTs are, but even a precursor to an NFT is the idea sometimes people buy experiences. What is that experience? So NBA has developed experiences that people can buy utilizing a blockchain technology. State Farm and USAA basically had somewhere around 200 checks or something like that, I think, a day that they were, 200 checks a day that they were sending between themselves. And by implementing the blockchain technology, they reduced the number of checks by 80%. And so we all know the cost that it takes to produce a manual check and send that out. So we can imagine that that's a pretty good benefit for State Farm. And then Walmart also is in the health arena and USDA and in terms of looking at kind of safety around food and things like that. So pretty exciting mainstream big name companies that are actually already and have been using blockchain for a number of years. So this technology is not fly by night. It's not new today. We're hearing about it today. We follow Bitcoin, but Bitcoin's been around for many years now too. But the technology is there.
So I think one of the things that Dennis pointed out, which is very interesting, is that a big difference between fiat currency and cryptocurrency is that there's nothing with intrinsic value backing up cryptocurrency. So it's based entirely on speculation. And that translates into it is extremely volatile. And this screenshot shows ups and downs just over a few months and how volatile this cryptocurrency can be. And so kind of jumping ahead to what we'll talk about much later in the presentation, the the volatility risk in and of itself is what has led most nonprofits that are currently accepting cryptocurrency are immediately converting those donations into US dollars, most American nonprofits, to limit their exposure. We're talking about limiting our risk. So there is a way to limit that volatility risk, and the way you limit that risk is by converting to cash and not putting yourself at that exposure. The lack of structured guidance will, as we talk more about the lack of structured guidance, you'll see why, again, why I keep falling on the side of saying, if you do accept crypto, convert it to cash. I listed up here some of the groups that give us the most structure, and we talked about it earlier, but the FASB and AICPA guidance, FinCEN, know your customer guidance, the IRS regulations, and the Department of Labor. None of these groups have really come out with clear, structured, uniform guidance in the area of cryptocurrency. And that lack of, if you go ahead and advance to the next slide, thank you. That lack of clear authoritative guidance is pretty troublesome. So what we do know is it is lawful. There is nothing illegal about accepting cryptocurrency donations, but crypto is largely outside the control of government or financial institutions. The FASB has not yet formally addressed cryptocurrency. ERISA guidelines are unclear, and the DOL has not yet released any formal guidance. Cryptocurrency is generally not insurable, and the laws that regulate cryptocurrency lack coordination and consistency among jurisdictions, so from state to state. And the last thing that we know, which definitely causes some concern, is that gifts that originate from criminal activity may be subject to clawback in some jurisdictions. And so we certainly don't want to expose ourselves to clawback risks if we can help it. The IRS published 45 FAQs, at least the last time I checked there were 45, maybe there are more now, 45 FAQs related to virtual currency. As far as the IRS is concerned, crypto is treated as a gift of property. That's why when we talked about the motivation, there are individuals out there who have experienced long-term capital gains in cryptocurrency investments, and they would like to gift these cryptocurrencies to charities so that they can get the tax benefit of not paying tax on those gains, which is a definite motivation for them. The cryptocurrency is reported on the 990 as a non-cash gift because it's a gift of property. It's reported on 990 Schedule M. And then these last two bullet points are very important because many of us have never really spent much time in completing or submitting IRS forms 8283 and 8282. So an 8283 is required for every donation over $500, and if the donee is responsible for the 8283. So if a donee wants to get credit for the charitable donation, they complete the 8283. And if the donation is over a certain threshold, they need to get an officer of the donor completes the form, and the donee has to sign, a donee officer has to sign acknowledging that gift so that the donor can claim the charitable donation. If an 8282 is the responsibility of the donee, so as as a nonprofit, if you accept a donation of cryptocurrency and then you sell it, exchange it, or otherwise dispose of it within 3 years, then you have to file a Form 8282 with the IRS. So basically what this is additional paperwork that, that many of us may not even know is required. And in order to stay compliant with IRS regulations, we need to make sure that we understand what is required and what we have to complete for each donation that we accept. And we'll talk some more about how we can mitigate this risk by contracting with third parties that can help complete all these forms and file them on our behalf. But they are required, and everybody should know that. So what about the AICPA? So the AICPA issued a practice aid on the accounting and auditing of digital assets. And they state very clearly at the beginning that the objective of the practice aid is to develop non-authoritative guidance on how to account for and audit digital assets. And then they also state that the publication is not approved, disapproved, or otherwise acted on by the Accounting Standards Board, the membership, or the governing body of the AICPA. And the practice guide is not, does not represent official pronouncements of the AICPA. So I don't know about all of you, but that makes me feel really comfortable in terms of AICPA's guidance on accounting for cryptocurrency. In the practice aid, which and at the end, if we do give you a link to review the practice aid, because it truthfully is very informative and there's a lot of information in there. But some of the characteristics that we learn about cryptocurrency is that the biggest challenge we face in tackling the lack of accounting guidance in this space is the variety and the speed of emerging technology. As we stated in the beginning, there are over 19,000 types of cryptocurrencies, and there's a lot of other digital assets. Cryptocurrency is currently the largest population of digital asset. And as we said, it has no inherent value and operates independently of a central bank. And cryptocurrency is transacted on blockchain, and blockchain represents a paperless real-time ledger. So the AICPA does clarify a lot of the characteristics that we've already talked about, but that variety and speed of technology and the number of digital assets that are out there leads to the next question. When we finally do get some stronger and more clear authoritative guidance, are we going to be able to account for all digital assets the same way, even all cryptocurrencies? And there's a lot there. This leads to a lot of other questions with the variety of digital assets that are out there. We have to be open to the possibility that maybe accounting for them all is not going to be the same. The practice aid also tells us a lot about what cryptocurrency is not. So the AICPA is very clear that crypto is not issued by a jurisdictional authority. It is not identified as legal tender, even though it may be very easily and readily converted to cash. It is not a contract between the holder and another third party. It is not considered a security under the Securities and Exchange Acts, and it is not a tangible physical asset. So the AICPA has told us very clearly what cryptocurrency is not, and then we have to then use, by process of elimination. On our next slide, we can see that if we employ the process of elimination, cryptocurrency is then classified, right now, is classified as an intangible asset with an indefinite life subject to impairment guidance. So what does that tell us? Currently, we would have to account for crypto under ASC 350-30, general intangibles other than goodwill, which means that we report the initial carrying value at cost, and we test the asset for impairment at least annually, more frequently if the asset may be impaired. And this one is subject to interpretation, but if we're accepting cryptocurrency donations on a regular basis, then we know when that asset has become impaired. So the guidance, the impairment guidance says that if the fair value is less than the carrying value, you recognize a permanent impairment loss, which means you may never write it back up if the fair market value recovers. So if you know that your digital asset has been impaired, you're supposed to write it down, and you never get to write it back up again. So the accounting mechanics are very much counterintuitive to the expected performance of the asset. Most people, I think, who are investing or trading in cryptocurrency are hoping that the market fluctuation is going to be favorable to them. But as you can see, if you hold on to crypto, the reporting the testing for impairment and reporting those permanent impairment losses, it can be a challenge.
Now, if our heads were not spinning enough when we talk about crypto, at least we can compare crypto to a dollar, which we know, and we think of it in currency and have something to compare it to. When we talk about NFTs and some of these other non-crypto digital assets, we have to put ourselves in a frame of mind of potentially the holder to understand the value more so. So what are NFTs? NFTs can be anything. It gives right of ownership and to a digital asset, and that could be an image. It could be some virtualization of something. We're going to talk in a moment about Jack Dorsey and Twitter in an NFT that I think put some light to it. But we've seen NFTs come into pretty commonplace, for many different types of organizations trying to put together something that makes sense. But for example, you might have music. We understand music and copyright and the value of copywriting to the holder of that copyright. But similarly, but we all understand music. We like to listen to music. But when it comes to an NFT, what is really that value? If you purchase this NFT, it's on your computer, it gives you right to something. In some cases, we can understand it because it might be artwork, and sure, that artwork would be displayed digitally. It wouldn't be a painting, but is it any different than a physical painting in terms of the consumer or the person that holds it? We know Bill Gates' house for years has had technology that, based upon the individual walking through the hallways, the artwork would change on the digital monitors based upon profiles. So this is actually kind of cool. Samsung has a TV out now that's very thin and it has a frame around it, so it mimics basically a framed something, and you can change the artwork on that screen. So these are scenarios where maybe instead of buying that watercolor or the oil painting, you're buying a digital version of that. Collectibles, I mentioned the NBA a little bit ago, but as kids, I mean, I collected baseball cards when I was young. What is that value? Well, what about if those baseball cards are virtual now? They're digital, something that is unique that can be conveyed to me for value, and then I can then sell it for potentially value. But there's nothing that I can trade. I mean, the NFT aspect, right? I can't trade it. It's not like a $20 bill. You know, I can have a $20 bill in my pocket, and I can go to Karen, and Karen has a $20 bill in her pocket, and we can change them, and it's the same 20. You know, the value is the same to her and to I, based upon those $20 bills. But if I have a baseball card in my pocket, and Karen has, how do I change that for the $20 bill in Karen's pocket, unless there's some understanding of what the value is between it? So that's what makes NFTs a little bit more difficult. But, you know, some real life scenarios, we get into virtual reality, and if we really want our head to spin, we can go back literally 18, 19 years ago. I think 2003, Second Life was out there, and the idea that you could create an avatar in this second world, the fact that you know, Facebook and Meta and all of this online stuff right now, there are 10,000 worlds that have been created on Facebook or Meta's new platform, where people can go and create a life in those worlds. And we understand it in terms of gaming, the online gaming scenario. People can play a game, and they can increase the value of their role that they're playing in that game, and then they can sell that. And so that is a non-crypto digital asset. Domain names are probably one of the easier ones for us to understand. You know, if we today have a unique single word domain name, it's probably worth something decent. So, you know, domain names are easy, and then ownership records kind of go in line with that. But how do you track that in all of those aspects? But let's talk a little bit more about, on the next slide, Jack Dorsey, because this is to me amazing. So, you know, there was a gentleman in Iran that decided not too long ago to purchase Jack Dorsey's NFT that he created for $2.9 million of his first tweet. And I'm not quite sure what that value is, but he did pay $2.9 million for it. And to Karen's point about kind of that the need to write off the value, here he thought that he was going to you know, have something that was going to skyrocket in value. He listed it for auction, hoping to get $50 million on his 2.9 investment, and no one bid more than $280. So maybe that'll change now that, you know, all of the Elon Musk's entrance into Twitter, who knows? But the idea of speculation and what that means, I think is kind of big. And, you know, this aspect, we just don't know how to put some context around this. But, you know, it is truly someone's emotional decision here, right? It's an individual. But in corporate America, we've seen speculation that hasn't worked out well. And we saw it with AOL and Time Warner, which was at the time, I think, the biggest M&A type of activity, 65 billion. And basically in no time at all, they had to write everything down because it didn't work out. We saw it with Mercedes and Chrysler, Google and Motorola, Microsoft and Nokia. The list goes on in terms of very smart people thinking that there was going to be some level of synergy and speculation that combined value is going to go up. Well, here's an individual that made an investment, but it probably didn't work out the way that he wanted.
So one of the things I wanted to talk about too, we shared a lot about what the lack of structured guidance and regulations. But as Dennis is talking about all of these different types of digital assets and the volatility and the just knowing what's out there, what we didn't talk about is who actually owns the digital assets. And you've all heard, and we don't have time in today's presentation because it's mostly about accepting donations. But similar to cash, whoever is the holder is owning these assets. And one of the things we have to talk about is if you're trading in cryptocurrency, you are subject to the Know Your Customer regulations. And most of us are familiar with that from the standpoint of getting the paperwork from our banks once a year or so and filling out the information that they require. But just to break it down a little bit further, FinCEN, or the Financial Crimes Enforcement Network, requires that all money service businesses register as money transmitters, and they comply with the anti-laundering and regulations, anti-laundering and countering regulations. So what this means is that we have to, if we're going to accept cryptocurrency, we have to choose how we're going to do that, and we'll talk a little bit more about that further into the presentation. But basically, we're either going to establish an account on a crypto network ourselves, or we're going to utilize a third party. And if you establish your own account on a network, you are subject to these know your customer regulations. So we have to be aware of what our obligation is to register with FinCEN, and we are putting ourselves in a position to determine whether or not we are unintentionally enabling money launderers. So there's significant risk there if you establish your own account on a crypto network and start exchanging cryptocurrency. And one of the ways we can satisfy ourselves, a SOC 1, SOC 2 report from a third party exchange, if we utilize a third party exchange service, we are asking them to certify to us that they know these regulations and they comply with them, similar to how we trust that our banks are complying with the Know Your Customer regulations.
So when we think in terms of accepting gifts, this is something, most things, in my time in the nonprofit world, if you don't have a policy for something or you haven't thought about something, that's when you end up with a whole lot more work to do. So it's often a little bit easier to spend the time in advance to think about how these things will impact your organization from an external standpoint as well as from an operational standpoint. And what we do know is that certain gifts can harm the mission. It can drain finances and it can impact reputation. And we can have, there are countless examples of this, and probably even more so today for certain types of organizations than was the case 10 years ago. But what we do know is that if you're able to define it, then you can have a plan around it, and then you can execute to that plan. Over the course of the last year, countless organizations we've helped to implement the ability to accept crypto, and we've had conversations with them. And I can tell you that the ones that have struggled the most have been ones where they were struggling with how do we feel about this, right? Is from a gift acceptance, should we be? So for example, some organizations that have very much an environmental component to their mission, or it's part of their ethos in many ways, really just have a problem with the fact that Bitcoin is not that green in terms of acceptance. Though, quite frankly, neither is gold, right? I mean, mining for gold is not very environmentally friendly, but we don't think about that. We don't talk about that very much. We talk a lot more in terms of crypto and in a general society, that there is acceptance that crypto is not totally environmentally friendly. So that could damage a reputation or be a problem. That also, when different types of organizations have different types of funding mixes, whether it be mainly individual focused, foundation or corporate focused or federal focused, one of the key things is to make sure that whatever you're doing from your gift acceptance policy, are you putting other major funding streams potentially at risk, and that can come in a number of ways. But really looking at the mission of the organization, who do you want to be, and what does it mean when you accept potentially gifts from individuals that you may or may not know that much about, and how much do they align. The other is that, you know, this is not all that unsimilar in terms of, in my past life, we didn't have a clear gift acceptance policy at one point, prior to my working at an organization, and someone who was very well known and a very good donor to the organization decided to gift a timeshare to the organization. And you talk about kind of that draining of finances, the amount of money that it costs to deal with that and get out of that was pretty significant. Similarly, a boat scenario. So what is the policy? But, you know, in other terms, and Karen mentioned this, and in a couple of slides, we'll drill down on this a little bit. There are many organizations that very efficiently accept car donations today. And why do they do that? Because they work with one of a handful of agencies out there that's their mission, is to actually accept the car, dispose of the car, and send the cash to the nonprofit. And it's very clean and easy to do that. So it's a process in place, and that's a good example of gift acceptance policy. Whereas if you're you know, ABC nonprofit in Baltimore, Maryland, looking to accept a car, and someone gives you a car, and then what do you do with it, and how do you deal with it? So I think that these are the types of things that really are key in terms of that policy, not just in terms of the donor, who the donor is, and what types of gifts you want to accept, but let's say that you're going to accept it, then how do you manage it? How do you deal with it? And on the next slide, we can kind of drill down just a little bit in terms of examples and looking at just crypto itself. But basically, one of the key things is to be very clear about what you accept and how you accept it. And also, even to some degree, depending on your organization, why you accept it. And then, you know, very clear about any requirements of information sharing that's there. Make it very clear about how the IRS defines it, but also at the same time, just like you always, whenever anyone makes a gift, you always refer them back to their tax advisor. Don't assume the role of being that advisor, but highlight, provide the information, and encourage them to get their own expert opinion on different things. Summarize, you know, the process, summarize liquidation process, what happens, and I think that this is really key in terms of what happens. And the next slide is just an example that I think is pretty clean and clear in terms of that type of process and what it is and how to do it. And I think that putting together the plan, making sure that you have your policy in place, and then everyone is clear and above board in terms of what you're going to do, most of the concerns can be mitigated, and it can be a positive experience. You know, there's one thing that I did not mention back on the slide where we were talking about the crypto versus the fiat currency. But one thing that I think is really important to know, and especially from a donor standpoint, is really important. Many organizations, as part of their policies on their website, will have some detail around what happens related to refunds. And so if someone is requesting a refund related to a donation, what happens? What is the process? If you're using crypto, there's no such thing as a refund. So it is a permanent transaction. It's not going back. So making sure that you're very clear about that, because at the end of the day, one of the things we never want to offend a donor. We don't want anything to be problematic with a donor, especially if it's a major donor. So the more clear and upfront that we can be, so as to avoid any of that potential just confusion or issues that might develop that damages that relationship, I think is really key. And on the next slide, let's assume that maybe somehow through this last 45 minutes, there's been a focus on becoming more of fear of missing out. What do we do? Number one, I think focus in on those third-party intermediaries, and Karen will talk a little bit more about that, but they definitely do provide a quicker and easier and lower risk scenario than going it alone. But more importantly, like most things, do not build it and expect to fill the stadium unless you have a plan. So at the end of the day, relationship, relevancy, repetition are going to be essential in developing a program that actually drives crypto donations to your organization.
So let's say we've made the leap of faith and we've decided we are ready to jump in and we're going to accept cryptocurrency. There's three basic ways that we can do that. And I saw the results of the polling. Most people in this audience who have donor acceptance policies right now have a policy 50% that you can't accept crypto. I think it was 4% of our audience has a policy that accepts all digital assets. So we know we're a long ways off. We have a lot of work to do if we're going to get to this point. But once we get to the point, what are those three ways? Number one, you can manage it in-house. And there's a lot of risk in managing a cryptocurrency exchanges in-house. First of all, you have to have an exchange account, but most importantly, you have to have somebody who is knowledgeable and responsible for executing those transactions. So you have to get that expertise in-house if you're going to manage this process in-house. And for that reason, with that and all the other risks, the know your customer rules and the FinCEN regulations, with the clients that we're currently working with, I am not personally advising any of my clients right now to manage this process in-house because of all these risks and not having that response, that knowledge, that in-house expertise to manage the process. So then what are the other two options? I'm going to skip to the third option first because the donor advised fund is the safest way to take crypto donations, because when those donations reach the nonprofit, they're actually in the form of cash. So if you haven't addressed your donor acceptance policy, your gift acceptance policy yet, or you don't have any procedures in place, but you have a donor reaching out to you who really wants to give to you and wants to give in the form of cryptocurrency, right now the safest way to do that is to direct those donors to a donor advised fund. Fidelity Charitable, Schwab Charitable Impact, Co-Catalyst Impact are some examples. The donor advised funds, they assume all of the know your customer risks. You don't have any need for the IRS forms 8283 or 8282 because you're, as I said, by the time the donations reach the charity, they are in cash. One of the other things I want to mention briefly as we talk about the third option in the middle here, utilizing a third-party payment processor. One of the things that's also important for nonprofits and should be addressed in your gift acceptance policy is how you want to treat anonymous donations. And are these donations anonymous just to the public, or are they anonymous to the charity as well? And that's one of the questions you want to ask before you engage a third-party payment processor is, do they know who the donations are coming from? And is that information available to you as the recipient, even if it's not available to the public? Third party provide for the know your customer requirements, but you should check with the third party processor to see what their policies are and how they are complying, and making sure that they're working on your behalf and they're complying with all these regulations. Most of the third-party payment processors offer the nonprofits an option to automatically convert to cash, and this significantly reduces your risk. That it reduces all that market risk and all the accounting risks associated for trying to account for those gifts of property. And finally, the third party, most of the experienced, especially the ones that we've looked at, the larger ones like Giving Block and InGiven, they will handle donation receipts and the IRS forms 8282 and 8283 for you. So they, and the fees, obviously, there are fees associated with third-party payment processing, but they do assume a lot of the risk for you and assume a lot of the administrative tasks that go along with preparing these forms and receipts. So we really recommend, if you're going to start accepting cryptocurrency and you've addressed your gift acceptance policy, to consider one of these two methods, either a third party or a donor advised fund. Finally, we wanted to just talk a little bit about some of the potential benefits that addressing cryptocurrency can have. One of those potential benefits is that it provides an opportunity for finance and development to really work together and work cooperatively. It's really important, and most of us know this, even if we're talking about donations in dollars and cash and fiat currencies, that it's important for finance and development to work together to understand things like how pledges are going to be handled, how restrictions are going to be handled, how matching gifts are going to be handled. And it becomes even more important with gifts of cryptocurrency, that we understand if there are any, what the purposes are and what the donor intentions were in donating these assets. And if we're certain that we have a method in place to capture the donor intent and to understand any possible restrictions that might have been placed on these gifts. And we will provide for anybody who is interested the copy of the materials, and we have some resources that we used in researching this presentation, and a link to that CPA Practice Aid that we mentioned. Now we will take questions in the chat and try to address them, or we'll get back to you if we can. One of the things we didn't talk about was holding cryptocurrency, because the purpose of this this webinar was to talk about donations, and so we didn't address that. But if anybody, we would be very interested to know if any of you are currently holding any cryptocurrency in your investments, and if so, we'd love to hear. Another thing we didn't dig into in this presentation was security, IT security around acceptance of cryptocurrency. And certainly, if you are considering managing acceptance of cryptocurrency on your own in-house, you really would want to make sure you work closely with your IT providers to make sure you have the proper securities in place on all of your systems, and with all the have access. Thank you again, everyone, for your attendance, and we hope to see you in a future webinar as we continue our not-for-profit webinar series.